Is a stock market crash on the horizon? Experts are weighing in, and you need to be prepared. Welcome to Stock Market Crash Coming. What experts are saying. Stay ahead of the game, like, subscribe, and hit the bell for the latest financial insights. Let's dive in. The stock market has experienced significant volatility in recent years, driven by factors such as inflation, interest rate hikes, geopolitical instability, and shifting investor sentiment. Many investors and financial analysts are now questioning whether the market is heading for a major crash or simply a period of slower growth. While some experts predict a severe downturn, others remain optimistic about the market's ability to recover and continue its long-term upward trajectory. Given the current economic conditions, it is crucial for investors to understand both the risks and opportunities that lie ahead. Concerns about a stock market crash. 1. High market valuations and speculative investments. One of the biggest concerns among market experts is the issue of overvaluation. Several major stocks, particularly in the technology sector, have seen their prices soar to levels that some analysts consider unsustainable. Companies like Nvidia, Apple, and Microsoft have reached all-time highs, raising concerns that the market is in a speculative bubble similar to the dot-com era of the late 1990s. Bill Smead, founder of Smead Capital Management, has warned that the stock market is on the verge of a multi-year bear market. He argues that the current market momentum is driven by speculation rather than strong fundamentals, making it vulnerable to a sharp correction. According to Smead, many investors are overly optimistic about growth stocks and ignoring the risks posed by rising interest rates and economic slowdowns. 2. Inflation and interest rate pressures. Persistent inflation remains a significant challenge for global economies. While inflation rates have moderated compared to their 2022 to 2023 peaks, they are still higher than the historical average. Central banks, including the Federal Reserve and the European Central Bank, have taken aggressive steps to combat inflation by raising interest rates. Higher interest rates can have a negative impact on stock prices because they increase borrowing costs for businesses and consumers. This can slow economic growth, reduce corporate profits, and lead to declining stock valuations. Some experts worry that the Federal Reserve may have to keep interest rates elevated for longer than expected, which could put further pressure on the stock market. Additionally, the potential for a rate shift from the Bank of Japan has raised concerns among global investors. Japan has kept interest rates low for years, and any sudden increase could send shockwaves through global financial markets, particularly in the bond market. Given the interconnected nature of the global economy, a policy change in Japan could have ripple effects on US and European markets. 3. Economic slowdown and recession fears. Another major concern is the possibility of an economic slowdown or recession. Many analysts have noted that economies like the US and the UK are experiencing a form of mini-stagflation, where economic growth is slowing while inflation remains high. Historically, markets tend to struggle in these conditions, as companies find it harder to maintain profitability. The bond market is also flashing warning signs of a potential recession. The yield curve, which measures the difference between short-term and long-term interest rates, has been inverted for an extended period. An inverted yield curve has historically been a reliable indicator of an upcoming economic downturn. If a recession does occur, corporate earnings could decline sharply, leading to widespread stock market losses. Some analysts believe that the market has not yet fully priced in the risk of a recession, meaning that a downturn could trigger significant sell-offs. 4. Market rotation and investor sentiment shifts. Investor behavior has also been changing, which could indicate trouble ahead. Market rotation refers to the movement of money from one sector to another. Recently, investors have been shifting funds away from high-growth technology stocks into defensive sectors, such as consumer staples and utilities. This trend suggests that investors are becoming more cautious about the market's future. When money moves into defensive sectors, it often signals that investors expect slower economic growth or a downturn. If this shift continues, it could lead to broader market sell-offs, increasing the risk of a crash. Why some experts remain optimistic. Despite the concerns raised by some analysts, Others believe that a stock market crash is not imminent. Many economists argue that while the market may experience short-term corrections, long-term fundamentals remain strong. 1. Resilience of the U.S. economy. One of the key arguments in favor of continued market growth is the resilience of the U.S. economy. The job market remains strong, consumer spending has held up, and corporate earnings have been better than expected in many sectors. These factors suggest that the economy may avoid a deep recession, allowing stocks to continue their upward trend. Additionally, the U.S. government has taken steps to support economic stability, including infrastructure spending and investment in key industries such as clean energy and technology. These policies could provide a boost to economic growth and support stock prices. 2. Positive long-term market trends. Historically, the stock market has always recovered from downturns. Even in the case of severe crashes, such as the 2008 financial crisis or the COVID-19 crash of 2020. Over the long term, the market has continued to deliver strong returns for investors who stay invested. Many analysts expect the S&P 500 to continue rising, albeit at a slower pace. The median year-end target for the index is around 6,600, representing a 9% increase from current levels. This suggests that most Wall Street analysts do not anticipate a dramatic crash, but rather a period of moderate growth. 3. Investment opportunities in defensive sectors. While some high-growth stocks may be overvalued, there are still opportunities in other sectors. Many analysts recommend shifting focus to industrials, energy, and healthcare, which are expected to perform well even if economic growth slows. Companies in these sectors tend to be more stable and less affected by short-term market fluctuations. Additionally, dividend-paying stocks remain attractive for investors looking for stability. These stocks provide income even during market downturns, making them a good option for those concerned about volatility. What do you think about our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.